In this video, we will continue looking at adjusted basis. Recall that adjusted basis is calculated as the original basis minus accumulated cost recovery, for example, accumulated depreciation, plus capital additions. And we need to know how to calculate adjusted basis in order to compare it to the amount realized upon the sale, disposition, or exchange of an asset, so that we can figure out a realized gain or loss. Now, the original basis that we start with depends on how the property was originally acquired. In the previous videos, we looked at if property was purchased. If property was purchased, then we use the cost basis. If the property was acquired because of a donor's gift, then we use either the gain basis or the loss basis. In this video, I'll look at a situation where a taxpayer received property through an inheritance, that is, from someone who passed away. If property was received as an inheritance, then the basis to the recipient is the fair market value on the date of the decedent's death. This is known as the primary valuation date. If the asset has appreciated in value, then this is known as a step-up in basis, because the recipient now has a higher basis, the fair market value, than what the basis was to the decedent when he or she died. So what happens here is that the new owner, the recipient of the property, will not pay any tax on the appreciation while the decedent held the property. That is essentially tax-free appreciation. In another nice feature, the holding period here to the recipient is actually automatically long-term, even if the recipient only held the asset for 1 day or 3 months or 10 months. If it's inherited property, it's considered long-term property. And thus, if it produced a long-term capital gain, it will be subject to preferential tax rates. Finally, the taxpayer can pick an alternate valuation date, which would use the fair market value 6 months after the date of the decedent's death. However, there are many rules here, one of which is that the fair market value actually must have gone down between the primary valuation date and this alternate valuation date. So if we're talking about appreciated property, the step-up in basis would be smaller on the alternate valuation date than the step-up would be available on the primary valuation date. One area of importance around inheritances is that there can be some smart tax planning going on here. Generally speaking, if a taxpayer has appreciated property and he or she wants to give it to you, from a strictly tax perspective, it is better if the person simply holds on to that property and gives it to you after they die. That way, you get the step-up in basis, so that if you were to ever sell the property later, you have a higher basis against which to compare the amount realized. This will make any realized gain as small as possible. If instead the taxpayer gifted you the property and then you sold it, well, if it was appreciated property, then from the previous video we saw that we would use the gain basis or the donor's adjusted basis as our basis. That is, there would be carryover basis, not a step-up in basis. And thus all of that appreciation that was earned on the asset by both the donor and you, the recipient, would be subject to tax. Again, from a strictly tax perspective, it would be smarter to obtain appreciated property through an inheritance than through a gift, because of the generous step-up basis provision. So this small tax planning tip brings me to deathbed gifts. Some savvy, perhaps insensitive taxpayers might use elderly or dying family members as a vehicle to ensure a quick step-up in basis on their own property. So how do they do this? Well, let's say I have appreciated property, and I know that my great-grandfather is very ill. If I gave my great-grandfather my appreciated property, then when he dies he bequests it back to me through an inheritance, then technically I've just engineered a step-up in basis because I received property from a decedent. Heck, what I should really do is give my great-grandfather all of my appreciated property so that once he passes away, he can bequest it all back to me, and voila, I have a stepped-up basis in all my appreciated assets. And thus will never have to pay tax on that part of the appreciation, even though I actually held it while it appreciated. Well, as you can imagine, the IRS doesn't like this scheme. Therefore, the IRS will not allow a step-up in basis if you round-trip your appreciated assets through people that will just bequest it back to you when they die. More formally, the rule says that if a decedent received appreciated property as a gift during a 1-year period ending on the date of the decedent's death, that is within 1 year of the person dying, and the property is acquired or received by the decedent from a donor or donor spouse who expects to inherit the property back from the decedent, then the IRS says the property will have a carryover basis and not a stepped-up basis. That is, the basis will carry over from you to the decedent and back to you with no step-up. So sorry, no loophole here. Well, at least not within 1 year of a person's death. More than 1 year? Well, it actually might be possible. Let's look at a quick example. Doris, who was terminally ill, received a gift of land from her son Steve on September 1st, year 20X1, when the fair market value of the land was $10,000. Steve had purchased the land 10 years ago for $6,000. Doris died on December 15th, year 20X1, and bequeathed the land, which was then worth $11,000 back to Steve. In the first question, what is Doris's basis for the land on September 1st, 20X1? That is, what is Doris's basis for the land on the date that Steve gifted her the land? Well, since it was a gift, then we can assume Doris's adjusted basis is the donor's adjusted basis, or Steve's basis carried over to Doris, or $6,000. So here, no change in basis because it was a gift from Steve to Doris. Now, under the general rule for inherited property, what would Steve's basis have been on December 15th, 20X1, when Doris bequeathed the land to him upon her death, assuming Steve did not originally give her the land before she died? Again, this is under the general rule. What happens to basis when Doris bequeaths property to Steve? Again, assuming Steve never owned that land in the first place. Well, under the general rule, Steve would have received a step-up in basis to $11,000. That is, his basis would be the fair market value on the date of Doris's death. Now, under this 1-year exception, under deathbed gifts, what is in fact Steve's basis on December 15th, 20X1, using our original fact pattern? That is, assuming he gifted Doris land, she died, and then she bequeathed it back to him, would he have a step-up in basis or just a carryover in basis? Here, because he gifted Doris his land, and within 1 year of the gift, she bequeathed it back to him upon her death, he does not receive a step-up in basis. The basis that carried over to Doris upon gifting carries right back to him upon Doris's death. So, his basis of $6,000 remains the same as before he gifted the land to Doris. Finally, a little bit of a twist. What if Doris made a capital improvement to the property of $2,000 after its receipt from Steve, but prior to her death? What would Steve's basis be on December 15th, 20X1, when he received the land back from Doris? Well, like before, under the 1-year exception, the $6,000 basis in the land he gave to Doris would carry right back. However, because Doris made capital improvements independent of Steve, she does add the $2,000 in the capital improvements to the basis. Recall that the formula for adjusted basis equals original basis minus accumulated cost recovery plus capital additions. This is a capital addition. So technically here, Steve's basis would be $8,000, or the $6,000 carried over plus the $2,000 in capital additions that Doris made on the land. In summary, the key point with property obtained through an inheritance is that if the property is appreciated, the recipient will receive a step-up in basis up to the fair market value on the date of the decedent's death. The basis is not carryover, as it would otherwise be best case scenario in the gift basis scenario. There's certainly some tax planning to be done using the step-up in basis provision, but the 1-year exception limits at least the most obvious schemes to quickly engineer a step-up in basis by round-tripping appreciated assets through any near-death relatives or acquaintances and getting those assets back once they pass away.